presentation contains current opinions of Moe Sansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compact Market Wrap YouTube update for August the 4th, 2025. I'm Mo Ansari, President of Compact Asset Management, and thank you for joining me today. First of all, I want to remind all of you to go ahead, click on the subscribe button so whenever I post an update, you will be notified. Also, you can go to compact.com, click on Insights, and you can go to the podcast, this YouTube update, and all the other communications that we have. They're all free. They're all at compact.com/YouTube. If you need help with your portfolio, you can always send us an email at invest@compact.com or just give us a call. Let's start with the numbers. Last week, down 2.34% for the S&P, down a big down week. Worst week for the Russell, down 4.16%. We saw the emerging markets and international markets down 3% or so, and the NASDAQ was down 2.16. Dow was down also nearly 3%. So pull back in the markets. Again, I've talked about this for the last 2 or 3 or 4 weeks, where 63.50, 64.50 was my target. Today we're back up sharply, but still at 63.25. We're still 100 points off from the intraday high that we made on the S&P last Thursday. We did get a lot of data last week. We did get the data on we had the Fed meeting. They didn't change interest rates. We did get the GDP number better than expected at 3%, but that was down 0.5% in the first quarter because the imports surged in the first quarter as importers brought in a lot of goods, and that is a subtraction from the GDP number. So that's why the first quarter GDP was down. This, we did not see a lot of imports, so the exports went up, and that was in addition to the GDP number. So we're getting a lot of volatility. -1, -0.5 in the first quarter was, I think, too low. 3% GDP number that we got for the second quarter is too high. I think we're somewhere in the middle. When you add the two up and take an average, I think GDP is 1.5% right now, which in tells me that the economy is slowing. We got the unemployment data sharply lower than expected and big revisions for the May and June unemployment numbers. That means the jobs created were down dramatically for those 2 months. So the economy is slowing. The head of the BLS was fired by the president. I think, again, that is just data. It is reported from a whole bunch of different offices and just compiled in Washington. So firing the head of the BLS or the Bureau of Labor Statistics, I don't think will have impact, but it does impact the credibility of the data. I think the Fed should start lowering interest rates. I've talked about this. I think the consumer is going to start to get worried about prices, and we'll talk a lot more. I'll talk a lot more about that. Every sector last week was down, except utilities, which was the only one that was up. Consumer services were unchanged, while materials was down 5.4% last week. So utilities, again, the demand for energy is going up dramatically, especially most of that is based on data centers using a tremendous amount of energy. Oil was down and is down again today. OPEC has increased production, which should put downward pressure on inflation. Again, Fed interest rates were down sharply last week as we saw the unemployment data come out much weaker than expected. The employment data, it went down. The interest rates were down from 4.4 to 4.23. Again, the Fed, I think, missed an opportunity to lower interest rates by 25 basis points. Now the expectation is they are going to lower interest rates in September, and that could be a larger cut. It could be 50 basis points. And this week we could see the next chair of the Federal Reserve basically as a shadow chair of the Federal Reserve, because one person is going to be nominated to the board, one person not as a chairman of the board, but as a person to the board. And this person could be the next chair of the Fed. They're going to be appointed he or she is going to be appointed by the president this week. So that, I think, can have an impact on the markets. I think overall, I've said that I think 63.50 to 64.50 was an initial target. We got there on Thursday. We backed off quite a bit on Friday, bounced back up today. We could bounce around for a little bit longer before we have a pullback. Now, how deep, how long, it depends on how the economy does, how all the numbers start to come out, what happens to inflation, what the Fed does. So we have a lot of different moving parts. But overall, I think the market is fully priced. One of the things I'm watching, as I mentioned, the biggest thing is the consumer. That's 2/3 of the U.S. economy. Total spending, you can see it's okay. When you look at healthcare and pharmacies, they're doing well. But I think people can't cut on medicine. If they have to take the medicine, they have to take it. But if you look at airlines, they're down. You look at gas stations, again, this could be misleading that their sales are down. Not that because their people are using less gasoline, it's just the prices are down. So the consumption could be down. But airlines, lodging, I think the post-COVID boom is coming to an end. People are becoming much more selective, much more careful in what they buy. And I think that's going to sort of permeate the economy and the consumer. If that happens, that could contribute more to the slowdown in the economy. And GDP growth, as I mentioned, came in third quarter GDP at 3%. Job openings ticked down by 250,000. Non-farm payroll came in at 73, worse than expected. But the downward revision for May and June numbers were what was really dramatic to see. So we are slowing. Question is how much? Are we slowing to a point where everybody starts talking about a recession? I don't see that. I don't see that, but I do expect a slowdown in the economy. I think the retailers have absorbed as much as the tariffs as they could, the importers have, and the exporters have. Now I think it's going to start passing through all the inventory that all the retailers had accumulated. That's being used up. So now when they import stuff, they have to pay the higher tariffs, and that will start showing up in prices. But again, that could be a one-time short-term increase in prices. What I think more so is going to be the demand destruction that we could see if prices start to go up, where the consumer decides, maybe I shouldn't buy this, or I should hold off on it. And if we start seeing that, that could be a major slowdown in the economy. Not a lot of data coming out this week. ISM non-manufacturing comes out. That could have a little bit of an impact. But last week was the big data week, and all the data showing that the economy is slowing, in my opinion, the way I'm looking at it. Again, this was my target, 63.50 to 64.50. That's this, and that was a projection from this high that we got in February. It projected to a high 60. Here we are in the middle of August, 6 months later, and that's when we saw this high. This is a daily chart. We came down sharply, gapped down on Friday after we got the data below the 20-day moving average. Today we're back above it, but this was the high at 64.25 was the high so far. Now we could see a fourth wave pullback down to 61.30 or so, or this could classify as a fourth wave. We'll have to wait and see. Could see another rally up to the fifth wave, come up here, or just fail, or just nick it slightly. That's the way I'm looking at it right now. Each one of these vertical lines, the green and red lines that you see, is 1 day of trading. But when you go to the weekly charts, we're also seeing a fifth wave high, same target, 63.50, and we are starting to see some weakness here. And that, if we see a weekly chart for a fifth wave top, but that could take another month or so to happen, that would signal to me that we could see some kind of pullback here. On again, the monthly charts going back to about 15 years or so, each one of these lines is 1 month of trading. You can see this goes back all the way to 2009. Just about 2009 is right here. That's the low we saw. And then from there, we've seen a tremendous run in the market. And now we've seen a really big run since 2022. We've gone up much faster. But this could take 6 months to a year to make a top right here on the monthlies. So, but in the short term, we're looking at the dailies, which is showing that we could see one more rally or back a test of the highs. But after that, we could see a fifth wave top on the dailies. Weeklies are already showing that. Monthlies are showing that. So it's getting me a little bit concerned looking at the market right here that we could see some going into September, October. This is the seasonal time where the market pulls back a little. NASDAQ, same thing, third wave top on the dailies, right in the target zone that I was looking for right here. We got right in here, and now we've come back a little to 20,133 is the 50-day moving average. We're about 21,000, and 21,500 was the upside that I was looking for. On the weeklies, again, looking at a fifth wave, right in the target zone. Now, if we get above 21.5, that would be great. Then we could have a breakout to the upside. But until that happens, I would remain a little bit cautious on this market. 10-year note, dailies right here, just stuck in a very tight range, but down dramatically on Friday. Interest rates were down quite a bit, and we are at 4.19 today, down from the 4.4 area that we were hovering around last week or so. But we have to hold, again, interest rates going much below 4% would be a concern. That would show us that the economy is slowing too much and the people are worried about a recession coming. That's when interest rates go down. That's when the Fed starts lowering interest rates, trying to stimulate the economy. But this is not a F1 sports car where you just press the gas and we see immediate reaction. This is more like a super tanker. When the Fed cuts rates, it takes 6 months to a year for them to really start percolating through the economy. Gold was up big on Friday. Again, I still think there's one more shot on the gold market towards the 3550 to 3600 target. That's a projection from this high. I don't know what will cause it. Oil was down big. Again, down today, down about $1 a barrel, hovering around $66 a barrel this morning. So what we're looking at in oil, OPEC decided to raise production. What people are saying is, look, all these other countries, Saudi Arabia is saying all these other countries are selling as much oil as they can while we are cutting back production, and they're taking market share from us. So Saudi Arabia has decided that it's going to raise production and get back its share of oil sales, and that could put downward pressure on the oil market. Bitcoin gap lower on Friday. Again, as I mentioned, looks like a fifth wave top here, gap down. Today came back up a little, but still 62.87 is the ETF. That's IBIT is the symbol on this Bitcoin ETF. But again, showing a fifth wave there. So I'm getting, again, I'm looking at all of these charts, and it's telling me that even though today is a wonderful day in the markets, right now is where you need to look at your portfolio and make sure you have the right allocation in your portfolio. So you can go ahead and do that and make sure that you don't have too much risk, that you have the right degree of risk, that if you do see a pullback, that it does not affect you. Those are my thoughts. That's the way I'm looking at these markets today. Again, don't forget to subscribe to click on the subscribe button so you're notified. You need help. If you want somebody to look at your portfolio, now send us an email at invest@compact.com or call us at 800-388-9700, 800-388-9700. Those are my thoughts. Those are my observations. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.